Another area where you can optimize your debts are with student loans. We've talked about this a lot on our Escape Student Loan Debt podcast, which is not affiliated with New Money, New Problems. It's a separate business entity. But on that podcast, we've talked about the fact that you are going to see a lot of interest rate fluctuations during times like these. And the way private student loans work, you can see a major change in interest rates on a quarterly basis. So if you have a private student loan that's, say, at 8% interest, if you're checking rates for other loans, on a quarterly basis, you might find that during a 2 or 3 week stretch, you can apply for a student loan refinance at 6% interest, which could make a radical difference in terms of either keeping your payment the same, but still paying off that debt faster because the interest rate is lower, or even lowering your payment if it's the same repayment period at a lower interest rate, or just giving you the option of saying, hey, I have more flexibility in knowing that these opportunities can come up every quarter. And if I keep my eye on it, even if I don't strike now, I need to be aware that I can strike when the iron is hot. That's if you already have a private student loan. But even for people who have federal student loans, this is a very tumultuous time when it comes to federal student loans. It's not something that I would tell you to casually do, because taking a federal student loan and transferring it to a private entity cannot be undone. And there's typically far more flexibility when it comes to how you repay a federal student loan than what you have in the private student loan space. But if you are just fed up with all the stuff that's going on with the federal student loan space in terms of what payment plans are or are not available, what forgiveness credits are or are not being given to your account, then if you find an opportunity where there's a significantly lower interest rate in the private student loan space, then it might be time to consider transferring it over and actually paying the debt off in full at a lower interest rate as compared to trying to have it forgiven under an income-driven repayment plan umbrella. Another area of debt to pay attention to are variable interest rate debts. We will put a link in the show notes to episodes that we've done on adjustable rate mortgages or ARM loans. Credit cards are adjustable rates, and especially home equity lines of credit. These are debt vehicles where either on a certain increment basis or even a daily basis, when it comes to the tracker that they use to determine interest rates, you can see a change in what you're paying from one payment period to the next. And because of interest rate fluctuations during this time, it may be ideal to see what it would look like to lock in a fixed rate for some of those instruments. An example with the home equity line of credit would be that it is typically a variable rate product, but certain lenders will give you the opportunity of taking a certain amount of money that you owe on that line of credit and paying it back at a fixed rate. Now, that comes with an exchange. Typically, whatever fixed rate you sign up for is going to be slightly higher than whatever the variable rate is right now, right? They're not just trying to make it easy for you. If the variable rate right now is 8, they may say, yeah, you can lock in a fixed rate, but it's going to be at 8.5 or 9%. But if you're worried about what the payment's going to look like if that interest rate moves forward and how it's going to impact your budget, it might be worth you taking some of those portions and saying, I want to lock in a fixed rate and a fixed repayment period, so this is not hanging over my head in the event that it happens.